You spent 12 years in school. You learned calculus, chemistry, and historical dates you will never use. But nobody taught you how to balance a budget, understand interest rates, or build wealth. Today, that changes. Welcome to Wealth Can Do. This is part 1 of a 5-part series called Financial Literacy: What School Never Taught You About Money. Over these 5 videos, I'm going to teach you everything the education system left out, the practical, real-world money knowledge you actually need. Here is what is coming in this series. Part 1 today: Understanding money, income, and expenses. Part 2: Banking, credit, and debt. Part 3: Investing and building wealth. Part 4: Taxes and how to keep more money. Part 5: Building your financial future. Today, we are starting with the absolute foundation: what money really is, the difference between income and wealth, and how to master your expenses. This might seem basic, but I promise you, most adults do not understand this. Let us get into it. Let us start with the most fundamental question: what is money? Money is 3 things. 1. A medium of exchange, you trade it for goods and services. 2. A store of value, it holds worth over time. 3. A unit of account, it measures value. But here is what school never taught you. Money is not wealth. Money is a tool to build wealth. This is a critical distinction most people miss their entire lives. Money sitting in your checking account is just paper or digital numbers. Wealth is what you can do with that money, the assets you buy, the income streams you create, the freedom you build. People chase money. They work 40 hours a week for a paycheck. They save money in a bank account. They think more money equals more wealth. Wrong. The wealthy think differently. They do not chase money, they chase assets that produce money. A rental property that generates $2,000 a month. Stocks that pay dividends. A business that runs without them. This is lesson 1. Stop thinking about money as the goal. Start thinking about money as the tool to buy assets that create more money. This shift in perspective changes everything. And school never taught you this, because the system needs workers, not wealth builders. If everyone understood this, nobody would accept a 9-to-5 job trading time for money when they could be building income-producing assets instead. School taught you to get good grades, go to college, get a good job, and work for 40 years. They taught you that income comes from labor. Again, incomplete. There are 2 types of income. Number 1, active income. You trade your time for money. You work, you get paid. You stop working, the money stops. This is your salary, hourly wages, freelance work. Number 2, passive income. Money you earn without actively working. Rental income, dividends, interest, royalties. Business income that doesn't require your daily presence. Here's the truth school never taught you. You will never become wealthy on active income alone. Why? Because time is limited. You cannot work more than 24 hours in a day. Your income has a ceiling based on your hours and your hourly rate. Passive income has no ceiling. A rental property generates income 24/7, whether you're working or sleeping. Dividend stocks pay you quarterly, whether you're on vacation or at home. This is how wealth is actually built. Most people fall into the income trap. They get a raise, so they upgrade their lifestyle. Bigger apartment, nicer car, more expensive restaurants. Their expenses rise with their income. They're making $100,000, but living a $100,000 lifestyle with nothing left over. This is called lifestyle inflation. And it's why doctors and lawyers making $300,000 a year still live paycheck to paycheck. More income doesn't build wealth if your expenses match it. The wealthy understand this. They keep expenses low regardless of income growth. Every extra dollar earned goes into assets, not lifestyle upgrades. Here's the goal school never taught you. Build passive income that exceeds your expenses. That's financial freedom. If your expenses are $3,000 a month and you have $4,000 in passive income, you are free. You do not have to work. You can work if you want to, but you do not have to. That is the difference between being rich and being wealthy. Here's the secret wealthy people know. Every dollar you do not spend is a dollar that can compound. It's not about being cheap. It's about being intentional. Spend on what brings value. Cut everything else ruthlessly. Then invest the difference. This is the foundation of wealth building. Control your expenses. Maximize the gap between income and expenses. Invest the gap. Simple, but school never taught it. Let me give you the most important formula you were never taught in school. Wealth equals income minus expenses, invested over time. That's it. That is the entire game. Increase income, decrease expenses, invest the difference consistently over decades, and compound growth does the rest. But notice what's not in that formula. Your job title, your degree, where you went to school, what your parents did. None of that matters. Only the math matters. You can make $50,000 a year, spend $30,000, invest $20,000, and become a millionaire. You could make $200,000, spend $200,000, invest nothing, and stay broke forever. The formula doesn't care about your income. It cares about the gap. Let us run the numbers school never showed you. Scenario 1. You make $60,000 per year, $5,000 per month. You spend $4,000. You invest $1,000 per month, $12,000 per year. At 10% annual returns. After 10 years, $204,000. After 20 years, $687,000. After 30 years, $2,170,000. You are a millionaire on a $60,000 salary. Scenario 2. You make $150,000 per year, $12,500 per month. You spend $12,000. You invest $500 per month, $6,000 per year. At 10% annual returns. After 10 years, $102,000. After 20 years, $343,000. After 30 years, $1,085,000. So you make 2.5x more income, but accumulate half the wealth because your gap is smaller. This is the lesson school never taught. Income does not determine wealth. The gap determines wealth, and you control the gap. School never taught you this, but building wealth is 80% psychology and 20% math. The math is simple. Spend less than you earn, invest the difference. A child can understand this. Yet 78% of Americans live paycheck to paycheck. Why? Because humans are wired for short-term gratification. We want the pleasure now, and we'll deal with consequences later. Marketing companies know this. They exploit it. Buy now, pay later. You deserve this. Treat yourself. The education system never taught you to resist this, because the economy depends on consumption. If everyone saved 20% of their income, consumer spending would collapse. So school taught you to be a good consumer, not a good wealth builder. Here's the mindset shift that changes everything. Delayed gratification is the price of financial freedom. Every dollar you spend today is a dollar that can't compound for your future. Every dollar you invest today is working for you forever. When you are 25 and you spend $5,000 on a vacation, you are not just spending $5,000. At 10% returns, that $5,000 becomes $87,000 by age 65. You did not buy a vacation. You sold $87,000 of your future wealth for 1 week of fun. That is not to say never spend money on experiences. It is to say, understand the real cost. Make intentional choices. School never taught you to think this way. But this is how the wealthy think. Let us recap what you learned in Part 1 of Financial Literacy. What school never taught you about money. Lesson 1. Money is a tool, not the goal. Wealth is assets that produce income. Lesson 2. There are 2 types of income, active and passive. Wealth comes from passive income exceeding expenses. Lesson 3. Master your expenses. Use the 50-30-20 rule. Audit your spending. Every dollar counts. Lesson 4. Wealth equals income minus expenses, invested over time. The gap is everything. Lesson 5. Building wealth is 80% psychology. Delayed gratification buys freedom. This is the foundation. Everything in parts 2 to 5 builds on this. If you don't understand these basics, nothing else will work. In part 2, we're diving into banking, credit, and debt. You'll learn how banks really make money and how to use that to your advantage. The truth about credit scores and why they matter. Good debt versus bad debt. Yes, there's a difference. How to get out of debt permanently. If this video taught you something school never did, hit that like button. It helps YouTube show this to more people who need it. Subscribe to Wealth Can Do and hit the bell icon, so you don't miss part 2. This series is designed to be watched in order. Each part builds on the last. Share this with someone who never got financial education. Forward it to your family, your friends, and anyone who could benefit. Drop a comment. What's the one financial concept you wish school had taught you? Let's build this education together. Remember, wealth is not about looking rich. It's about being free. And freedom starts with financial literacy. See you in part 2. Rich people have high incomes. Wealthy people have income-producing assets that cover their expenses. School taught you to become rich. I am teaching you to become wealthy. Let us talk about expenses, because this is where most people lose the money game before they even start. There are 3 types of expenses. Fixed expenses. These are the same every month. Rent, car payment, insurance, subscriptions. You know exactly what they'll be. Variable expenses. These change monthly. Groceries, gas, utilities, dining out. They vary, but you need them. Discretionary expenses. These are wants, not needs. Entertainment, shopping, hobbies, luxury items. School never taught you this, but here's the rule. Your fixed expenses should be no more than 50% of your take-home income. Variable should be 20 to 30%. Discretionary should be 10 to 20%. And you should be saving or investing 20% minimum. Most people have it backwards. Their fixed expenses are 70% of income, they save nothing, and they wonder why they are broke. Here's a simple framework school should have taught you. The 50-30-20 rule. 50% of after-tax income is allocated to needs, which includes housing, food, transportation, insurance, minimum debt payments. 30% of after-tax income is allocated to wants, which include dining out, entertainment, hobbies, non-essential shopping. 20% of after-tax income allocated to savings and debt payoff beyond minimums. If you make $4,000 per month after taxes, $2,000 for needs, $1,200 for wants, $800 for savings or investing. This is a starting framework. The wealthy do 50, 20, 30. Only 20% on wants, 30% to investing. But 50, 30, 20 is the minimum to build wealth. Here is an exercise school never taught you. The expense audit. Track every dollar you spend for 30 days. Every coffee, every subscription, every impulse purchase. Write it down or use an app. At the end of 30 days, categorize everything. You will be shocked. Most people discover they are spending $400 plus per month on things they don't even remember buying. Those $15 subscription services add up to $180 a year. That daily $4 coffee is $1,460 a year. The $60 monthly streaming services you do not watch is $720 a year. That is $2,360 per year. Nearly $2,000 after tax, wasted on autopilot spending. Invested at 10% returns, that is $45,000 over 20 years you are throwing